We're joined on the floor here by a frequent guest, Art Hogan of Jefferies, just coming off ringing of the opening bell, here to talk to us about one of the newest ETF offerings out there, Commodities Equity ETF, which trades under the ticker, what is it?
CRBQ.
CRBQ. So this is equities, and it's benchmarked to the CRB index, which is a futures index.
Correct.
So what is the differential so far in terms of the ETF performance versus the index itself?
Well, it's hard to say after a week. So, think about the fact that this is something that's going to mirror what you get in the CRB. So you've got exposure to precious metals, industrial metals, ag, and energy. And people would really like to have exposure to commodities, but play that market without having to be in the futures market, without having to be in a market that actually cancels itself out every 30 days and you have to roll that forward. So this actually represents 70% of the privately held commodities on the planet, with 150 companies in 30 different countries around the world. It's a way to have a commodity exposure without actually having to buy the physical commodity or the future.
For instance, though, if we're talking about gold exposure within the commodity ETF that Jefferies has,
correct,
is it an investment in gold miners?
Correct.
That is the equity. So there is a differential there.
That is exactly correct. You're not buying physical gold. You're actually buying the folks that actually own, produce, mine, and have in-the-ground reserves of gold. And
Jefferies didn't backtest this?
Backtested it for about 10 years. Yeah, the composite index, and yes. And
so the correlation is high.
That's very well. Tested out very well.
Art, don't take this personally. I ask this question of everyone. Why do we need it under ETF?
Well, we need another ETF right now because people would like to play the commodities market, and playing the commodities markets and futures ETFs actually hasn't done very well. And you've seen several of the commodities futures ETFs, because of the roll forward cost, that have actually not done well. So think about it like this. You get that commodity exposure, but you're getting an equity exposure. So you don't roll things forward. You don't have that roll cost. You're actually putting money into those companies that produce food, produce gold, produce iron, produce ag products. So you're actually getting... you're actually doing something that's actually efficient for the marketplace as well, because if we need to produce more food, buying corn futures isn't going to help us produce more food. Actually supporting those companies or investing in those companies that produce food are actually going to help, as our global population grows. So
it will track the commodity stocks, but not necessarily the commodity prices.
Correct. That's correct. But to the extent that obviously commodity stocks typically will track, and historically have tracked commodity prices, it's not going to be a direct correlation, obviously, but it's certainly going to track. But think about it like this. If you're buying natural gas at $4 and it goes to $8, that's all the money you're ever going to make. If you actually own the companies that profit from natural gas going from 4 to 8, you continue to have those profits. You continue to have a multiple. You continue to have a dividend.
At the same time, there are certain breakdowns. I mean, for instance, when you're buying a gold miner, one of their biggest input costs is the price of crude. So at the same time, you're depending on crude to rise to some extent to help those companies that invest in oil, but you're going to put a ceiling on the investment in the gold miner companies, for instance, which will experience a higher commodity
cost. That's a very good point, but that's also why we'll break this down into 4 subsets. So this is the initial is a composite index, and then we'll break that down into 4 subsets, which will be energy, precious metals, industrial metals, and ag products. So you can actually say, well, you know what, I actually think that I should probably short the energy complex and buy the precious metals, or vice versa, if that's your thought process. So you'll have the ability to sort of play it both ways.
And of course, this gets around the whole issue of the CFTC limits on the futures, if that comes through.
The government would obviously like to see less speculation in futures markets. This gets you around that and actually shows you an ability to actually invest in equities.
Okay.
All right, Art, thank you very much, sir.
Thank you very much.
Art Hogan, Jefferies and Company.